Gas prices are falling. The drop is real. It is happening right now. And for millions of American families, it cannot come soon enough. For the past 2 years, filling up a tank has felt like a financial punishment. Every trip to the gas station has been a reminder of how much everyday life costs. But something is shifting. The numbers are moving in a direction that analysts have not seen in quite some time. The question everyone is asking is simple. Will gas prices actually fall below $3? And if they do, when will it happen? And who benefits most? To answer that question, you need to understand what drives gas prices in the first place. Crude oil is the biggest factor. When oil is cheap, gas gets cheaper. When oil is expensive, you feel it at the pump within days. Right now, oil prices are under significant downward pressure. Global demand is softening. Major economies are slowing. China, the world's largest oil importer, is consuming less than forecasts predicted. That reduced demand is pushing oil prices lower. Oil prices mean lower gas prices. The math is straightforward. Supply is the second major driver. OPEC and its allies have been managing production carefully for years. They cut supply to support prices. They increase supply to punish rivals. Right now, the cartel is facing internal pressure. Some members want to pump more. Others want to hold the line. That tension is creating uncertainty. And uncertainty in oil markets usually means prices drift lower while the arguments continue. That drift is part of what you are seeing at the pump today. Refinery margins are the third piece of the puzzle. Even when crude is cheap, gas can stay expensive if refining capacity is tight. Last year, refinery constraints kept pump prices elevated long after crude had fallen. This year, the picture is different. Refinery utilization is high. Capacity is available. The spread between crude oil and finished gasoline is narrowing. That is good news for drivers. It means the savings from cheaper crude are actually making it through to the price you see on the sign outside the station. So when does $3 gas actually arrive? The honest answer is that it depends on where you live. National average gas prices are a blended number that hides enormous regional variation. Some states are already below $3. Others are still stuck well above $4. The states most likely to see sub-$3 gas first are the ones closest to domestic refining capacity. Texas, Oklahoma, Arkansas, Mississippi, and Missouri consistently have the lowest pump prices in the country. Drivers in those states may already be seeing prices flirting with the $3 threshold or sitting just above it right now. The states that will benefit last are the ones with high state fuel taxes and limited refinery access. California is the most extreme example. The state imposes some of the highest fuel taxes in the nation. It requires a special reformulated gasoline blend that limits supply options, and it sits far from the major domestic refining centers. Even if national average prices fall well below $3, California drivers should not expect to see that number on their local signs. The same is broadly true for parts of the Pacific Northwest, Hawaii, and some northeastern states where taxes and logistics keep prices structurally higher than the national average. The timing question is equally important. Most analysts tracking this closely are pointing to the summer driving season as the key moment to watch. Historically, gas prices rise in spring as refineries switch to summer blend formulations and demand picks up. This year, that seasonal increase may be smaller than usual. Demand forecasts are being revised downward. Consumers are driving less. Electric vehicle adoption is finally starting to put measurable pressure on gasoline consumption in some markets. If the seasonal spring rally is modest, and crude oil continues its current trajectory, the window for sub-$3 national average gas could open sometime in the second half of the year. What does this mean for your finances right now? If you drive regularly, lower gas prices act like a direct tax cut. Every dollar drop in the price of a gallon saves the average American driver between $500 and $800 a year. That money does not disappear. It gets spent elsewhere. It reduces financial stress. It goes into savings or toward other bills. The economic ripple effects of significantly lower gas prices are real, and they are broadly positive for consumer spending, for small businesses that depend on transportation, and for the general mood of an economy that has been under significant cost pressure for an extended period. The risk to this outlook is always oil, a geopolitical shock, a hurricane disrupting Gulf Coast refining, an unexpected OPEC production cut. Any of these can reverse the downward trend in oil prices quickly and sharply. Gas prices can fall slowly and rise fast. That asymmetry is frustrating, but it is the reality of how commodity markets work. The path to $3 gas is open right now. Whether it stays open long enough to get there depends on forces that are genuinely difficult to predict with certainty. Watch oil, watch OPEC, watch the weekly inventory data. The answer is being written in real time.